All right, today we're digging into Baidu's latest earnings report. And folks, this one is a real head-scratcher. It's a classic case of what looks like good news turning out to be bad news. The company puts up solid numbers, they beat what the analysts were expecting, and the stock just tanks. So what on earth is going on here? Let's get into it.
Okay, so first, let's just look at the headline numbers. On the surface, this looks like a clean win, right? Revenue comes in at 32.74 billion RMB, squeaking just past what Wall Street was looking for. But the real story, the big surprise, was on the bottom line. Their non-GAAP earnings per share, which is a good way to look at their core profitability, came in at 10.62 RMB. That didn't just beat expectations, it absolutely blew them away by almost 15%. A really solid beat. And this is how the market reacted. Just a brutal sell-off. The stock closes down over 5.5% on the day. This right here is the whole mystery we're investigating. How does a double-digit earnings beat lead to a nasty single-digit crash? It just doesn't add up.
So here's how we're going to crack this case. First, we'll dig a little deeper into that headline contradiction. Then, we're going to unpack the story management was telling investors and contrast that with the market's much bigger worries. We'll tie it all together with the final analyst verdict, and then we'll look ahead with what we call the next call.
So yeah, let's start right there, with that central conflict. The numbers look good on paper, but the stock's performance on the screen? Oof, it was ugly.
And I really want to hammer this point home. You see a nearly 15% upside surprise on earnings. That's not just a little better than expected. That is a significant beat. And that's exactly what makes the market's reaction so confusing when you first look at it. Which, it brings us right back to that core question. If the numbers were so good, why were investors all rushing to hit the sell button? Well, the answer isn't really in what Baidu reported, it's in how they got to those numbers and what that signals about the future. Okay, so let's flip the script and listen to management's side of the story. If you listen to their earnings call, you wouldn't hear about a struggling company at all. No, you'd hear them pitching this vision of a company going through this incredible transformation, all built on artificial intelligence and, interestingly, a new focus on giving back to shareholders.
And this chart really tells their story perfectly. Baidu is trying really hard to reframe the entire company around AI. This AI-powered part of the business, think AI cloud, AI apps, that kind of thing, is now bringing in over 11 billion RMB every single quarter. That's 43% of their general business. This is the growth engine they want investors laser-focused on.
So, management laid out a really clear bull case. They said, look, we've poured 100 billion RMB, that is a massive number, into AI over the last 3 years to build this new core. And then, to sweeten the deal, probably for investors who are getting a little tired of waiting, they announced a huge $5 billion stock buyback and their first ever dividend. The message is powerful. We're growing with AI, and we're literally going to pay you to wait for it.
But the market heard something completely different. It's like they were listening to a different call entirely. Underneath all that AI hype, investors saw a company that's really fighting a tough battle against a weak Chinese economy, and that's just crippling its old core business. It's created what we call a two-speed business. And this slide just lays out the problem perfectly. You've got two different companies inside one. On the left, you've got that exciting AI growth engine. AI cloud revenue growing 34% year over year? That's awesome. But then you look to the right, at the legacy advertising engine. It's so weak that it actually dragged the entire company's revenue down about 4%. So the problem is pretty simple. The new, fast-growing AI business, it just isn't big enough yet to offset the slowdown in the old, massive advertising business. Honestly, this quote just captures the mood perfectly. After the earnings came out, the market's verdict was simple. No matter how cool your AI is, it can't fix the immediate, very painful problem of a terrible advertising market in China. So let's put these two stories together, management's AI dream and the market's macro nightmare, and deliver the final verdict on why this stock got punished. And really, it all boils down to this one simple phrase. It was a beat, but not the right beat. The quality of how they made their numbers mattered way more than the headline number itself. The market wanted to see strength in the core ad business, and they just didn't get it. And you could see this all over Wall Street's reaction. The commentary was crystal clear. Yeah, the AI progress is nice, but it's just not enough to make us forget about the weak ad business. Investors are now demanding to see a clearer path to actually making real, sustainable money from AI. And you saw this in the actions too, not just words. Morgan Stanley, for example, cut their price target on the stock from $150 down to $135, which just reinforced that whole cautious vibe. Okay, so that's the story of what happened. But what about what's gonna happen? Well, that brings us to the next call, our take on where this stock goes from here. Based on everything we've looked at, we are officially assigning a rating of market perform to Baidu.
So, what does market perform actually mean? Well, it means we expect Baidu stock to pretty much do what its peers or the broader market does over the next year. It's not a call to rush out and sell, but it's definitely not a screaming buy either. We're basically neutral, kind of in a show me or wait and see mode.
So what are we watching for? Well, for the next little while, the stock is probably just going to be stuck in a trading range. For it to break out, either up or down, we need to see a couple of things. The first catalyst is real, tangible progress on making money from AI. I'm not just talking revenue, I'm talking profits. The second catalyst would be any sign that the Chinese ad market is finally hitting a bottom. Now, the one thing holding it all up is that big $5 billion buyback. That should act as a nice floor on the stock price.
All right, now for something a little different, a potential trade idea. If you want to play the AI story here, but you're worried about that macro risk in China, you could think about a pairs trade. The idea is to basically isolate Baidu's unique AI potential from the general weakness of the Chinese internet sector. So here's how it works. You would buy Baidu stock, that's your long, to capture that AI upside and get the protection from the buyback. At the same time, you would short a broad China internet ETF, something like KLABADWB. That's your hedge against the weak ad market that's hurting everybody. The goal here is to make money if Baidu's AI really takes off faster than its peers, even if the whole China market stays weak. It's a way to bet on the company, not the country.
And of course, this is not financial advice.